Talk a little bit about the U.S. economy. We got an inflation reading for Canada today, which arguably keeps a Bank of Canada interest rate cut in September in play. But there's a lot of moving parts. Now, you had the headline consumer price index increasing slightly less than what was expected. There were some signs of belt tightening by Canadians in certain categories. Nearly 2/3 of the monthly inflation coming from food and shelter costs. Those are hard to avoid. The tricky thing for the Bank of Canada might be core inflation, which still seems to be running too hot for the BoC, and whether or not it's that next jobs report, the August jobs report, which I believe we get early next month, ultimately sways them in one direction or another. We'll find out. But let's get some reaction now. Nathan Janzen is Assistant Chief Economist at RBC. Joins us. Nathan, nice to have you with us. What was your take on the inflation story today?
Yeah, I mean, I think it was it was a downside surprise relative to what we were expecting. We actually expected the rate of inflation to hold steady in July, and it edged a little bit lower. But it is, important to note this is really, one downside surprise following a string of mostly upside surprises. So I think you mentioned some of the Bank of Canada's core measures already. But those looked better on a month-over-month basis in July. If you look at the one of the measures the Bank of Canada has used in the past, it's core services excluding shelter, which is meant to be or has been used in the past as a better indicator of kind of underlying domestically Canadian-driven supply and demand driven inflation, which really matters for the Bank of Canada. That measure actually posted its smallest month-over-month increase in a year by our count. But you still have all of these core measures running at a 3% rate. That's still at the top end of the Bank of Canada's 1% to 3% inflation target range, and you are still seeing some pockets of inflation out there. Food price inflation, particularly still running above a 3% rate. So good in terms of some slowing in price growth, but probably too early for the Bank of Canada to declare victory.
And I was looking at some analysis from the economics team over at Bloomberg, and they note that one challenge for companies in Canada right now is that they are struggling in certain cases to pass along some of their own higher input costs, if those are tied to the trade situation, to consumers. And whether or not that's going to sway the Bank of Canada, I guess for fear of what ultimately it means if, they're eating that cost and it starts to hurt their business, and those businesses have kept a lot of people gainfully employed. They haven't been hiring a lot, but they also haven't been firing a lot.
Yeah, and so that's absolutely one of the concerns that the Bank of Canada will continue to have is how weak the labor markets get. I think the encouraging thing on that side is that those cases are out there. There are businesses that are being significantly impacted by higher tariffs, but it looks like it is still a relatively small share of the Canadian economy as a whole that's being impacted directly by tariffs. This backstop that we've had in place. That's keeping duty-free access to the U.S. As long as products are CUSMA compliant has still been backstopping duty-free access for most Canadian exports. So labor markets have softened from where they were in the winter before all of the trade uncertainty began, but they have shown signs of stabilizing in recent months.
And what about, just to dig deeper into the idea of belt tightening, Nathan, what are you guys seeing in your numbers? I mean, Canadians have been bombarded with headline stories of uncertainty. Is there, evidence out there that people are thinking twice about, their purchases right now? It seemed like that was evident in even the Home Depot numbers. And look, they've got a pretty big presence in Canada as well. So I wonder if, as much as we're talking about core inflation challenges, should we also have a conversation around disinflation potential or worries?
Yeah, so I mean, I think on the spending side, the good news is that spending hasn't been as weak as some of the consumer confidence metrics would have said that it should be. And so consumers certainly have been worried about the economic outlook. Spending has actually been relatively resilient, and we see that in Statistics Canada retail sales data. We also see it in our own tracking of card transactions, kind of in our own data. So it's not that spending is particularly strong, but it's held up substantially better, than some of the confidence metrics, and that's actually probably part of the explanation for why inflation has also had a bit of a floor underneath of it. Is that consumer demand hasn't actually softened as much as certainly there were significant concerns that it would be a lot worse at this point, back in the spring.
Okay, so I mentioned we'll get that next jobs report early next month. We'll see what is happening on the employment side. You've heard all these things about, renewals of mortgages and sort of are Canadians ready to meet those payments? Where does the economy end up? Clearly, the economy has, to your point, has navigated better than what some had feared. But let's get into the interest rate story, because I think, by the end of this week, we're going to be talking what's the Fed doing. As we get into September, same story. What's the Fed doing? What's the Bank of Canada, you think, going to be doing on interest rates this fall?
And I mean, I think you said it. The economy has been better than feared. That doesn't mean that it's been great. The unemployment rate is still higher than it was. GDP growth, over the first half of the year, still looks pretty slow. We expect it to remain slow going forward. The unemployment rate, is up 0.5 point from a year ago. So economic conditions aren't great. But if you think from the Bank of Canada's perspective, conditions haven't been soft enough to drive a significant disinflationary trend at this point. And you have significant interest rate cuts already in the hopper from, the Bank of Canada was more aggressive at cutting interest rates a year ago. So interest rates are already lower than they were in Canada. And the other thing the Bank of Canada will have to continue to keep an eye on is just the scale of fiscal response to tariff disruptions. And so there's an argument that fiscal policy, federal and provincial government spending is better suited to provide kind of a targeted relief to sectors of the economy that are being significantly impacted by tariffs, and that's a better policy response than further interest rate cuts. So there's lots for the Bank of Canada to think about. Our own base case has been, provided labor markets are close to their trough, the unemployment rate is close to its peak. Inflation is still running above target, that the Bank of Canada doesn't cut interest rates further. But certainly there's still scope to do so if it were needed, if the economy were to start to surprise on the downside.
Okay. Appreciate that analysis. Nathan, thanks very much for joining us, and we'll obviously see what happens from here. Nathan Janzen is Assistant Chief Economist at RBC.